All right. Thank you, Isaac. We're good to go. So, my name is Melissa Tierney, and I'm a realtor by trade. I'm a certified real estate planner, and that entails a lot of hats. My focus is on the senior niche. And in focusing on the senior niche, I have found that a lot of people in the senior space own not just property, but more than one property. And I often find myself asking them, do you have the income that you need to sustain the life that you desire? And a lot of people say, well, that's why I'm in real estate, but I'm tired of these things. And so then my next question is, well, what is your equity doing for you right now? What if we could find a better way? And we go down a lot of deep rabbit holes about what those strategies can look like. And that's where I've met people like Charles and Kim, who are also on this call, because together we've put together some really lucrative strategies for people who have reached a certain point with their properties that they want more and they want to do something. They have wealth they need to unlock. And that's where this call is really going to be the focal point is what kind of strategies are out there, what kinds of options are out there for people in different situations, and why it's so important to schedule that one-on-one consultation with us to really get into the weeds on what are your possibilities because there are a lot. So you will hear from me first. When it comes to our goal for today, you're going to get a lot of market trends, general market insight. We're going to be talking about the 1031 exchange. A big purpose of this call is to really demystify that process. There are a lot of different levels of people on this call, and I want to make sure that we're all on the same playing field. So we're going to start out with the basics and kind of go into some nuanced things regarding the 1031 exchange. Now, at a certain point, rental properties do become a burden. We're going to talk about the strategies that we run into in the field. My intention for this webinar is for everybody on this call to really have some new aha moments and really have a new set of questions to ask yourself that will result in having different conversations with your power team of four. So my background, really, I've taken my real estate license to the next level by really studying the ins and outs of senior living. Downsizing is a thing. I just did a massive project here in Santa Barbara where um, the power of attorney slash trustee got the call that her senior loved one couldn't go home. She was in a skilled nursing facility, and the senior loved one with cognitive decline and a lot of other things just couldn't go home. So she called me and she said, "Well, what do I do? Do I get a moving company?" And I said, "No, no, no, no. This is downsizing, and in downsizing, you need to hire a senior move manager, somebody who is a member of the National Association of Senior Move Managers." And then we start from there. And then when it comes to what do we do with the real estate, those are different levels of questions. And the interesting thing about the real estate is most people don't realize that the baby boomer generation is actually in a position of not just selling power, but purchasing power because there's so much wealth in the baby boomer generation because they have the real estate and they're actually reshaping the way today's market is transacting real estate. And so that's why we do what we do because we don't want to just transact real estate for the sake of cashing checks. We want to really make sure that our clients are building and protecting and transferring the generational wealth that they have worked so hard to build. So, in terms of state of the market, a lot of people have questions about, well, where's the market now, and should I buy now or what do I do? And I say, well, what do you think is going to happen if rates go down? It's going to unleash more buyers who are going to come in and they're going to flood the market and it's going to drive prices up. Um, I have some complete breakdowns on my YouTube channel about what I think is going on and really getting into some data, very localized data. And I really break down the Santa Barbara monthly market momentum. So for questions on that, follow me on YouTube. But for the sake of today's topic, it's important to call out. Now, Isaac, can you give me a thumbs up if you can see the graph this time? The last webinar we did, this is the graph we couldn't see. Okay, thank you. So if we look at 22-ish years of Santa Barbara real estate activity. When we look at sales volume stacked against the average interest rate, there are a few patterns I just want to call out. So in the mid 2000s, even with rates in the 6% range, we still had strong transaction volume. We were looking at 2,300 to 2,500 deals per year. But if we fast forward to 2021, rates really bottomed out at 2.65%. And that's when we hit that historic peak in sales. But look at what happens after that, right around, oh, you probably can't see my cursor. But if you look back at what happens after that, rates spike back to 7% range. Sales volume collapses. And that's between 2023 and 2025. And those are the lowest transaction years in decades. And the key insight I want everybody to take from this is that prices have not collapsed alongside volume. This is not 2008. This is a market that's frozen by interest rate lock-in, not a market flooded by distressed sellers. So what does that mean for our investors? For our investors, that means that liquidity has significantly decreased and opportunities are harder to come by in this market. Rents are very strong and are only going to strengthen as would-be buyers remain locked out. And the real play here is positioning, using tax strategies, wealth transfer tools, and estate planning vehicles to maximize what you already own and being ready when volume inevitably returns. And so this chart is really proof that the next big opportunity wave is coming, and those who are prepared will capitalize on it. And so the question to ask yourself or ourselves is not just what's happening. The real question here is what is my move in this market? And that's why we do these webinars. So, what is going on now? We are currently seeing the biggest demographic shift in history. And my question to the people that we talk to is, are you prepared? What would happen? What happens if something happens to you? I talk to a lot of people who say in their trust that they say that their assets are in a trust and they're going to let their kids fight over what's left and when they're gone. Um, the problem with that mentality is that somebody has there's an echo. Can you put me on mute? Thanks. So the problem with that is that there's usually a home and the home cannot physically be divided. So your current goal should be to ask yourself these questions. What does your ideal scenario look like? And then from there we can determine where do we start to build a plan to prevent family feuds, family disputes. I mean, there are a lot of rabbit holes we can go down there. But that's kind of the point, is to prevent the disputes and the feuds. So, have you ever heard of a family who fought over real estate after mom and dad passed away? I've seen a lot of that, and I'm sure a lot of us have seen that too. So, the sale of real estate, regardless of if it's emotional or logical, I want you to keep in mind whether it's an emotional decision, being we choose where we live based on who's around, or it's a logical decision because the numbers make sense, but it's a taxable event. And by the way, paying taxes to live in your home, you've got to pay taxes upon selling the home, and we pay taxes on the income we make to afford the home. So the point of this is that taxes are inevitable. And it's important to classify the two. The home that you live in is your primary residence. That's going to be the emotional decision. And the home that you do not live in, that's going to be your investment property. And so this is where we really get into the nitty-gritty of, well, let's talk about the primary home. And when I meet with adult children who have a senior loved one in the family, one of the first questions I ask is, how is this home working out for your senior loved one? And I get a lot of mixed reactions to that question. And then my next question is, well, what's stopping you from moving? Or what's stopping you from making the needed change? What's stopping you from moving forward with this? And that's where it's important to really self-discover the best path and plan around it. And that's where, when we look at investment properties, I run what's called an asset performance test. And we look at the numbers and break them down in terms of, well, how is it performing in the market? Does it make sense? Here's some questions to write down. Does it make sense to rent this home out for two tax seasons and turn it into an investment property if it isn't already one? Or maybe we keep renting it at this amount. And this is where someone like Isaac can come in and help with planning for numbers around future needs, because ultimately we want to leave a legacy. And by the way, when it comes to transferring wealth, the transfer of wealth is a thing. Because if somebody owns property and they own it with another person, when the last surviving person passes away, that's the date of wealth transfer on that property. It's going to be passed down to people if it's in a trust, or it's going to be passed down to the next of kin, depending on the situation. But that is a date of actual wealth transfer. And my question to everyone when I have this conversation is, are you prepared for that? Is there a plan in place? And one of the most important things that we could do is meet with someone like the people on this call, and we start by looking at the market and we start by asking ourselves, well, what's our play in this market? And then let's talk about, well, what if we do sell? If we do sell, we're going to go down the rabbit hole of looking at the sale price minus the cost of selling. Title will provide a net sheet with loan balances, liens, anything like that. And then we get a figure that we can take as our net proceeds. But this is where the title the title sheet is very helpful, but where the power team of four really comes into play is being able to look at the cost basis of the home and help to determine what, if any, capital gains taxes could be incurred here. And then the next question is, well, did we work that hard to over our time with our time in the workforce to give that kind of money to the government? I'm going to say no, but this is where we're going to estimate cost basis, potential capital gains taxes, verify it with the CPA, and this is where we're going to want to come up with a plan for the real estate. Because when it comes to cost basis, the simplest explanation I can give when it comes to cost basis is, if you like your kids, don't put them on the title of your house. That's the simplest thing I can come up with, because there are two types of cost basis. There's the step up in cost basis, which is where somebody inherits a home and they inherit a home at the value of the property as of the date of death. But when there's a carryover in cost basis, the value of the property carries over from the time when somebody else purchased it. So the value of the home is significantly less. It's not anywhere near fair market value like it would be in a step up in cost basis. And if somebody were to sell after being in a carryover cost basis situation, they would likely incur massive capital gains taxes. So that's why we say that. Now, when it comes to evaluating capital gains taxes, um, capital gains tax, we use this very general formula, and we're going to look at, net selling price being the selling price minus closing costs, and then other things like repairs can be factored in. But California especially is number one in the country for capital gains taxes. I think we're at 14%. Is that about right, Isaac? 14%? Yeah, okay. So so factor in 14% capital gains taxes, and that's just on the selling of an investment property. If we're working on primary residence through IRS code 121C, there would be the credits to the cost basis in the form of $250,000 for a single couple, 500,000 for two people on title. So those credits would go towards the gain of the primary residence, but still with the cost of selling and the prices being where they are, there's still a lot of room for there to be taxable gain. But when it comes to selling investment properties, this is where it pays to have a plan, because if we take, and this is an asset performance test that I like to run, where we look at how the cash is performing, how your cash is performing. That's where we look at cash on cash return. And we're able to really drill down and look at, well, how is our cash working for us? And then we look at factors like depreciation and built-in equity. And this is where it pays to have those discussions to see, well, what else can I do so that my cash is working for me? Now, when I mentioned earlier a 1031 exchange, give me a wave in the chat if we're familiar with a 1031 exchange. Okay, so a couple people. A 1031 exchange is the process of allowing investors to defer paying capital gains taxes on the sale of their investment property when you purchase what the IRS determines to be like-kind property within a specific time frame. And you have to do this with a CPA guiding you. And I also recommend working with a financial planner like Isaac to ensure that we're really sticking on track with financial goals. So, um, and this is kind of the math on why we do the 1031 exchange, because if we if we look at the sale of $1 million property, you will see that the funds available in my pocket, for example, are going to be $707,000. And this is after the tax breakdown, as you see on the screen. Now, if I were to do a 1031 exchange on the $1 million property, I will not have $1 million in my bank. I will have $1 million to reinvest and put the money to work for me. So this is this is really just breaking down the math, and Charles and Isaac will go a little bit deeper into how these work. But for now, I'm just going to cover kind of the basics just to make sure we're on the same page. And by the way, when I mentioned earlier, one of the questions I like to ask people, especially if their primary residence is no longer working for them, maybe we're aging, or just certain things within the family are not working out the way that they need to be. And so when I ask people, well, how is your primary residence working out for you? And a lot of people say, well, it's not so good. One of the first things I like to ask is, does it make sense to rent out your family home for 2 tax seasons? Because when you do that, it ultimately can convert the home into a rental property. And then upon transacting the rental property, it would qualify or meet the qualifications for a 1031 exchange. Now, going into what qualifies for a 1031 exchange. It used to be that, or there, people used to be under the misconception that if you have a single family home, you need to sell it and buy a single family home in order to defer the capital gains taxes, and that's just not true. You can sell a condo and purchase vacant land to defer the taxes. This is what the IRS deems as like-kind properties. And first of all, you have to have the legal and tax advice from the appropriate professionals, a realtor who knows what these timelines are, a financial planner who's ensuring that the financial goals are being met, the CPA, and someone like Charles, if we're getting into the DST route. This transactions also need to be taking place in the United States, except for Puerto Rico. You cannot do a 1031 exchange on a villa in Italy. Darn. So first, kind of guidelines is when it comes to a 1031 exchange, we have to designate up to 3 different replacement properties within 45 calendar days of sale, or the 200% rule. So purchasing 200% of the original amount of real estate. So that means if we're selling $1 million worth of real estate, the 200% rule would say, well, you need to find up to $2 million worth of real estate to replace that. And then the second rule is that we have to close within 180 days of the from the closing of the relinquished property. And so this next slide is a visual of the timelines that need to be adhered to for the 1031 exchange. And this is where people get stuck. This is where we see a lot of people identifying properties fall out of escrow. There are a lot of different bumps in the road that tend to occur in this type of situation. And this is where we have found that, and just going back to what like kind is, this is where we have found a lot of investors gravitate towards the Delaware Statutory Trust because the Delaware Statutory Trust essentially, um, and what we're going to, this is what we're going to get into the weeds on today, because from my perspective on transacting the real estate, we can get a Delaware statutory trust transacted very quickly. And these are going to be, your Amazon warehouses, Delaware statutory trusts can also include, commercial real estate, senior housing, student housing. It's just that next level of investment properties that we normally wouldn't have access to, but you're still in real estate, and we're even actually collecting income on that. So I'm going to let Isaac and Charles speak to the nuances of the Delaware Statutory Trust. I'm going to just preface it by saying the Delaware Statutory Trust, you must be an accredited investor. It is approved for the IRS by the IRS for 1031 exchanges. And the reason that this is very attractive is because people don't have to deal with the proverbial tenants and toilets and trash or any type of property management issues or COVID exceptions. And we are seeing some pretty positive returns on the Delaware statutory trusts. In some cases, it's 4 or 5% of fees. There's Charles and Isaac will go into kind of the rest, but I do want to preface one last thing by saying you do not have control on when you exit the Delaware Statutory Trust. You got to let it run its course. And so going back to, is it a good time to do a 1031 exchange? Well, if you have a significant amount of equity, it is always a good time to do a 1031 exchange if you have a significant amount of equity. Hopefully, you have the kind of CPA who is managing your depreciation and giving you the ideal date to really capitalize on that depreciation and go and buy something else. Um, and then when it comes to creating that financial plan to leaving a legacy, that's why we do 1031 exchanges. And I'm going to give you two case studies on how we did that. So the home on the left is actually a midterm rental that we transacted with some local investors. They took out a DSCR loan, which is a debt service coverage ratio loan. Give me a thumbs up in the chat if I did not butcher that. But essentially, thank you, John. Essentially, what this covers is the DSCR loan looks at a property and the income potential that it has, and then they loan on that. And so with this property, what we did, the investors did not have to get their credit pulled. They didn't have to put together their P&L and apply and go through a lot of hoops. They just found the property, submitted it to their lender. They were able to loan on it with a DSCR loan, and now they're working on a midterm. They have a midterm rental now with an 8% cap rate that's doing very well. Um, and there's no equity involved in this. There's not a lot of this is just kind of an anomaly, but it is one of those things that you can build equity with the DSCR loan. Now, going to the home on the right, this home, this is a townhome just a little bit north of here, and the couple who owned it, they rented it out, and they were getting pretty tired of having to go up and just constantly fix something with the plumbing or some painting and gardening work, and They definitely had some issues with plumbing and needing to, just a lot of things that just kept adding up. And it felt like for them, they were having to make the drive a couple of hours each week just to go and fix something in the condo. And so what we did was I sold it and we made a plan with their financial planner to do the 1031 exchange into a Delaware statutory trust. And they're still in real estate, they're still collecting income, they're just going about it a little bit differently, and they're actually doing quite well. And then we do have a case study within our community about a woman named Anne. Her husband passed away. Together, they co-owned an apartment building. There are actually a lot of ways that we could have factored out how the legacy could have been built, and she had a lot of options because of her new step up in cost basis. But ultimately, the plan that she wanted was to bless her kids while she was still alive. And so this apartment complex was owned by the family trust. And so what we did was sell the we were able to sell the apartment building, and the the family each got to predetermine their inheritance. And through the trust, each of the kids were able to own their own home and raise their kids in it. So the mom was able to bless all four of her kids while she was still alive. Now, it's not the most profitable solution here. It's not exactly building all this equity, but the trust owns these four homes, and the goal of blessing the family while she was still alive was achieved. So that concludes my portion of the talk. And I'm going to turn it over to you, Isaac. I'm going to stop sharing my screen and you can take over.
Well, I think last time we did this, I kind of took over at the end.
Oh,
And
okay.
so,
Yeah, you want me to go next?
Charles, are you
Yeah,
ready, Charles, to hop
Yeah,
in?
absolutely. Absolutely. I'm here.
have at it.
All right. Awesome. And I'm going to send a request to share screen to you,
You
Melissa.
got it.
And excellent work. Sorry I'm off camera today, but I'll show my image here, my little screenshot of.
Oh, you didn't do your hair and makeup for me?
Nah, not today. I'm actually I'm on the road in Irvine between meetings here, but I figured better to do it this way.
Thanks.
I'm Charles Jensen, Managing Director with Inland Securities Corporation. I'm an expert in DST 1031 exchanges for the last 20 years and done over about 4 billion in transaction volume. So just introducing myself. And to piggyback onto what Melissa said before we bring on Isaac here at the end, um, Melissa, you mentioned about the 45 days, right? You have 45 days in which to
Yeah.
identify your replacement properties, 180 days to get these sold. And I'm just going to revisit this for 1 second to go over as we intro the DST, the Delaware Statutory Trust. We've already bought properties in advance that we're holding in these DSTs. So what I'm getting at is we've already pre-purchased the property, diligence is done. So it's much easier to select a DST than go out and find your own property because you're not worried about the 45 days expiring. The DSTs were created back in 2004-86 of the Internal Revenue Code. And the DST is basically much like an IRA or 401k or 403b. It's just a vehicle for your tax deferral, but for real estate and for 1031s. And they're eligible and considered like kind. So there's easy as one, two, three. Step one is you sell your property. Step two is the funds go to the qualified intermediary. And step three, through paperwork through Isaac Kim, your financial advisor, the funds get wired into a Delaware statutory trust. And again, the definition of like kind is an eligible property for 1031 is any property you've held for investment or business use, exchange into any property held for investment or business use. Um, so there's six major reasons people like DSTs. We'll go over these, and I'll pass over to Isaac. The first one, and this is in no particular order, just some ideas to think about. There's more than these. Is in a DST, there's up to 500 investors typically. Minimum investment's $100,000. So imagine we took my 100,000, we got Isaac's million, Melissa's 10 million times 500 people, and we're dealing with hundreds of millions of dollars. So imagine what we could buy. We could buy high quality institutional grade properties like ESPN, FedEx, AT&T's headquarters. It could be student housing, apartments, hospitals, senior housing, or self storage facilities. So hard for any one person to buy something of this caliber, but together we can buy these big institutional grade properties only the likes of BlackRock can buy, right? Um, the next thing to think about is no management. In a DST with 500 people, you can't have 500 people calling the shots. So what you're doing is you're allowing the sponsor of the DST, like the inland or whoever the sponsor of the DST is, to manage the property for you. So there's no tenants, toilets, and trash of managing real estate. You sit back and collect the income without the hassle of the day-to-day operations. So, for example, I own 3 different DSTs in Inland. Every first of the month, I get a direct deposit into a checking account and go to brokerage account, wherever you want it to go. So you get monthly income, monthly statements, a quarterly update on occupancy and property, what's going on. And at the end of the year, you get a 1099. So the good thing about this is it's not a K1 to start out, right? A lot of K1s are notoriously late. I'll blow this up a little bit for y'all. I had about 5 K1s come in October, and my extension ended October 15th, right? So it's a little scary. But the 1099s come out between January and March of each year, and it gives your percentage ownership. I'm circling here with my cursor. This person owns 2.7% beneficial interest of the DST. So based on what they invested, they own that much of the DST. They receive $77,808 of income in the course of that year, but it's offset by the interest expense on the loan. If there's a loan on the DST, which we'll talk about in a minute, or if you have any carryover um, depreciation left over from the property is sold, right? If it depreciates over 30 years and you sell it year 15, you got 15 years left, right? To give you an idea. So in this case, you can see the write-off that on 77,000 in this case, with the loan alone, they're at 41,790. So they're paying taxes on 41,000 versus 77,000. And if there's any leftover depreciation, which is not calculated into this calculation here. So it gives you an idea of taxes. You just plug this into Schedule E and you can figure out your income and write-off and figure all that out. Diversification in DST, you can have more than one property. It's a Delaware statutory trust. Just think about if you have a revocable living trust or something like that set up, it's not hard to do. When you go into a DST, we can have more than one property. Some DSTs are one property, like an ESPN or a FedEx facility, maybe. But a lot of times it's a portfolio. So for example's sake, hypothetically speaking, we might have 3 apartments in Tennessee in one DST portfolio. Your one investment gets you ownership of 3 DSTs. Could be 5 senior living facilities in Arizona in another DST portfolio, or maybe 10 stores facilities in Texas in another DST portfolio. So if you took, say, for example, $1 million, you can split it multiple ways in a 1031, maybe put a third, a third, a third. You just sold one property in Southern California and you went into 18 properties in 3 states and 3 asset classes. Diversification obviously spreads out your assets, allowing you more safety so you don't get burned if one thing happens in a property, a fire or a flood or something like that. Of course, we're insured for that. The next thing is limited personal liability. Whenever you sell a property, whatever you sell, the net sales proceeds is what you have to buy. So if your net sales proceeds from property is $1 million, you have to go back in a million in real estate equal or greater to defer all of your taxes. Anything less is considered taxable. So if you sold $1 million property, when an $800,000 property, you're paying taxes on the $200,000 you did on exchange. So a lot of people have to go to the bank to get a loan. If they sold a property that had leverage on it, they have to get new debt from a new loan from a bank. In a DST, the IRS realizes it's too difficult to give out 500 loans to 500 people. So what we do is we put one loan on the property. With one loan on the property, you, the investor, can absorb our debt on Inland's balance sheet. It doesn't go into your credit report. It's not technically your debt. It's non-recourse to you. What I'm telling you is you don't have to get financing. You don't need a loan. And all of the write-off of that loan passes to you as shown earlier through the 1099. So my point to you, you get all the write-off without the hassle or the liability of ever obtaining financing. Some of our DSTs are zero debt. Some are 50. Some are 40, 50, 80%. They're all over the place. You can blend any 2 or 3 DSTs to get the loan to value that you desire. So here's an example. If you sold a $1.1 million property, you need to replace it with 1.1 million, at least on the buy side. And you can see here on the left-hand side is an investor that sold a property that's sitting at 45% debt or $500,000. On replacement, they found a DST that has 48.5% leverage. What they did is they went up in leverage 3.5% or 65,719 to 1.165719 on the buy side. This way, they took care of all their debt requirements without ever getting a loan, got all the write-off from it. And with this, they've covered their IRS requirements. So in a DST, no financing, this is a huge deal. Think about the two hardest things in property and doing an exchange. Find your property. We already have it in a DST. Get your financing. It's already done through the DST process. The next thing is estate planning. As Melissa mentioned, a lot of real estate's getting passed on. And Melissa, I heard the stat recently. I was in Austin, Texas with a real estate research group, and they talked about all the trillions of dollars going through that silver hair tsunami baby boomer generation. 8
Yep.
trillion is real estate.
Yes.
Is the
80
number.
trillion. Yes.
8 trillion. So what's happening is parents are passing on to their kids an apartment building. Imagine leaving the kids with the tenants to us trash or managing the management company. They're going to fight over these different things. All they got to do is go into a DST, get diversification, higher income, and upon death, there's a step up in basis to fair market value to DST, and the income can be split to the kids until the DST is sold. So DST is a great option to keep, like you mentioned, Melissa, out of the fighting with the death process, right? And insurance policy, this is more of a conceptual thing we made up. Is of course we have insurance on the property, but there's assurance here that in a DST, we've already closed on the real estate, the loan's already done. So you could talk to Isaac Kim and say, hey, I need to back up my properties with a DST. I found something down the street, but I want to back it up or split it with the DST. You can do that because property number one can be what you're working on. Property number two and three through the three property rule can be a property identified as a DST. There's no charge for that. So just in review here, DST process, you sell your property, funds go to a qualified intermediary. You pick your DST portfolio, and then usually in 5 to 7 years, DST is sold. At that point, you can buy a new property on your own, roll into a DST, or cash out. It's all up to you. With that, Isaac, I'll hand it over to you for the finale here.
Okay, thank you very much. John, thanks for sticking around through all of this. I hope you found this to be pretty interesting. You'll be happy to know that my portion, I don't have anything to put up on the screen, and I'm going to be pretty brief, so we're near the end here. I am a financial advisor. You've probably met other financial advisors before. I help people manage their money, manage their wealth, and do intergenerational planning. What I do as a specialty and what most people call me for is I help people mitigate capital gains tax when they sell something of high value. So people typically call me when they sell a business and they want to know how can I pay less tax? Or they call me when they're selling their home or selling their rental property and they want to know how can I not pay tax? And when someone is selling rental property or a residence, I partner with Melissa because she helps you sell the property, and then I introduce some tax strategies to you that you can use to mitigate capital gains tax. Today, we're talking about a 1031 exchange and selling a rental property. Again, if you're selling your residence, you can talk with Melissa and we can help you with the sale of the residence regarding capital gains tax. But with the Delaware Statutory Trust, I work a lot with owners of real estate and they just want to get out of their property. They don't want to manage any more real estate. They want to continue getting income. And at the end, they want to take that asset and they want to pass it to their heirs using an IRS approved strategy. The Delaware Statutory Trust is IRS approved. And if we execute the strategy correctly, you can pass this on to your heirs, and the total tax paid by you and the tax paid by your heirs is zero. And it's IRS approved, so we know how the IRS looks at this. So my role in all of this is I am the intermediary between the seller of the real estate, which in this case would be you, and the Delaware Statutory Trust, which in this situation is being represented by Charles. We need a financial advisor as a go-between in the middle. You can't go to Charles directly, so I am the person in the middle as a financial advisor helping you execute this strategy so that, again, you can sell your property, not manage any property, continue getting income, and you pay zero capital gains tax if we execute the strategy correctly. So again, that's all I have to say. And with that, Melissa, I'll turn it back over to you.
I like to tell people that you're the guy with the menu on the DSTs.
Yeah, I can show you different DSTs. Charles at Inland, they don't have one DST that they offer out. They offer out several. So
Mhm.
I can show you the different DSTs that are at your I guess on the menu that are available for you.
Okay. Now, one of the questions that came in prior to, well, in the on the form is, and I think we already touched base on this, is is a DST scalable? As in, I think what they mean is transferable upon death. So I know we spoke about that a little bit, but can
Yeah,
we talk about, cost basis and whatnot with regards to the DST?
yeah, Isaac, maybe we can both say some words on this. In a DST, you get a step up in basis to fair market value. So when parents pass away, for example, or husband passes away, the wife gets a step up, or heirs, whatever, whoever it is, right? And at that point, there's just a new value on the portfolio, and this can go inside your trust. So as you're passing on the real estate, you can pass on to whoever you want. So not a big issue in transferring upon death at all.
Don't have a lot to add to that. Again, with step up basis, when the owner of the DST passes away, they can give the shares to their heirs. The heirs will get that step up basis, and then when they sell that, their shares, or when the DST is liquidated, because of the step up basis, the tax burden, we can get it down to zero, or it's going to be pretty minimal because you do get the step up basis. And again, this is all IRS approved. There's no question regarding how the IRS looks at this.
All right, thanks. And then the other question that came through was, what does it mean to be an accredited investor? So can you guys talk about that?
Do you want to take that one?
Sorry?
I was going to say, Charles, do you want to take that one?
Yeah, absolutely.
Okay.
So credit investor, it's one of three things, right? So it's one, two, or three, not all of them, right? So you have to have $1 million net worth minus the value of your personal residence. So it could be your real estate, rental property, added together, cash bonds, stocks, mutual funds. A lot of people, especially in California, credit don't even realize it. Or you're making 200,000 a year single. Last 2 years, expectation to make that this year, or 300,000 a year joint, a husband and wife or married couple. So that's the simple definition of accredited.
All right. Isaac, anything to follow up with on that?
No, it's a really simple definition. Like Charles said, it's any one of those three. You don't have to, all three do not have to apply to you. Just any one of those three will work. And like Charles said, a lot of people in California, they're already accredited investors. And if you own a rental property in California, there's a good chance you're already an accredited investor.
I love that. Okay. Wonderful. Well, you guys, we did this in 45 minutes. I think it's our new record. Um,
Very good.
yeah. That looks like that concludes our questions. I don't have anything else. So, with that, I think we'll bid you adieu and definitely reach out to me to schedule our one-on-one consultation just to talk about things and just ask some simple questions and self-discover what questions we need to ask you to move forward with your plan. That's really it. Thank you guys.
Thank you all.
Thanks, everyone.